Welcome everybody. This is the Thursday evening Viper trading webinar. If you are here to learn about trading the futures market, you are in the right place. But we need to get our standard disclaimer out of the way first, so let's go ahead and take care of that. All communications from Viper Trading Systems are for educational purposes only. Futures and Forex trading does involve risk, and there is a risk of loss. Nothing contained in this webinar, other webinars, including the live trading rooms, are to be construed as investment or trading advice. And of course, everybody in here does know that you do trade at your own sole discretion. Alrighty, well, welcome everybody. All right, let's do this. Tonight's topic is breakout trading breakouts. And before we jump into some charts and trades and looking at setups and what have you, I want to get a sense from the team as to your understanding of the terminology of breakout. What does the term breakout trade mean? Breakout trade. When you hear the term breakout trade, what does that mean to you? Some of you may have heard it, some may not have heard it. Some of you may actually trade it. Some of you may avoid them. And there's reasons for all of that that we'll get into tonight. What is a breakout trade? Jim asking a question here. Breakout trades, do they only occur approximately 20% of the time? Well, I don't know. I don't have an exact percentage there, Jim, but I can tell you this. We're going to, in depth here, cover sort of the pluses and minuses of breakout trading, because there's times when you want to take breakout trades, and there's a lot of times when you don't. And we're going to cover that pretty extensively tonight. Let's see here. William's saying his interpretation of a breakout trade is a break above support or a break below resistance. Okay, good. Higher swing, higher lows, and a breakout move. That's right. That's right, Jim. All right, good. So most of you get the program of what a breakout trade is. Let's look at some examples. Let's start off with some examples of breakout trades. And many times, let's just get a couple of charts up here so we can start to focus in on what breakout trading is all about and why sometimes it's good and why sometimes it's not. All right, let's get over to screen one. And here we go. For those of you that are visiting us, we have on this chart here a combination of pro indicators and a few platinum indicators. That's part of the indicators that we have as part of Viper. We pretty much like to trade the 4-range chart that you see here. This is a little bit different than a time-based chart like a 1 or a 5 or 15 minute. We feel that the range bars give a more accurate depiction of what the price action is doing. And of course, you see we have the dollar index here, DX. We're still in the June contract, although that's going to roll to September very quickly. The dollar index is the dollar future, and it is $5 a tick. It moves in a mirror image direction to 6E, which is the euro. And the dollar, of course, is the largest component of the euro. So we're not too surprised to see that. So we're going to cover a couple of basics before we get into talking about breakout trades. And the first thing is that when you look at, say, the left 2/3 of this chart, would you say that this market was trending, yes or no, and if so, in what direction? Trending, if so, in what direction? Left 2/3 of the chart. So essentially from, about here over to here. Trending or not trending? Yeah. Most of you are typing in the word trending yes, and it is a downtrend. Good. Now, I'm going to start on the left-hand side of this chart, and I'm going to work my way to the right. And we're going to talk about some very important concepts that if you can, sort of ingrain these into your trading psyche, if you will, that are going to help you immensely when you're looking for trades. Markets go through cycles, and the cycles are where you get periods of what we call consolidation, and consolidation is when a market is not putting in a series of higher highs or higher lows, as you see here on the left. This is called consolidation or sideways price action, and you can see here that you have a, there's more or less a resistance area up in here, roughly, and we have support more or less down in here. Right? Now, when the market comes down here, this is the dollar index, and based on the guidance that we have over here, the guidance is these large sort of chunky dots here. That's our guidance dots. What direction did we expect this market to go out of this consolidation box on the left? When we talk about breakout, a breakout refers to either a break up or a break down. And we can see here, some of you may or may not be familiar with this, the guidance in this case was short from these guidance dots, and so our expected direction was down. And of course you see that we came out of the box to the downside here, like such. Now, I think this is a good time to talk about the inherent risks of breakout trading. And this is why I have to say that several years ago, we first started Viper many years ago. We taught and took, breakout trading was an integral part of what we did in taking our trades. And in fact, if you see some of the names of some of the indicators we have, a lot of them have the term breakout in front of them. Breakout bar color, the swing high low, it's the trailing stops, et cetera, et cetera. Breakout is, and so you can see here, we kept that nomenclature in the name because there were so many people that had that. To change it would have been a major deal. So we just left the term breakout. However, we have changed, and most of you know this now, our style and approach to trading to what we call retracement or probe or pullback type trades. The difference is this. You can see that here, when you're in this upper range on the left here, that the market will come up and challenge the resistance area like such. See that? So, technically, yes, you are in a range, but you are clearly coming up and hitting resistance areas up in here, right? See it? Up in here. This is what you call retracement or probes into resistance. And in terms of trade entry, I think you would agree that shorting the market up somewhere up in here is far superior than trying to short a market when it breaks support down in here, for a couple of reasons. First of all, you can see that your stop would be considerably tighter. Let me put some trades on here and show you what I'm talking about. So what we're talking about here, the difference between selling a market up at resistance versus selling a market as it breaks down through here. Okay, this type of sale, short, is called the probe, where you're probing in a downtrend. You are in a downtrend, and you are probing resistance, and so you're looking for shorts on a rollover up here when the market hits resistance, and you're shorting it, and your buy to cover stop would be somewhere. Initial stop would be up in here. Possibly you could keep it that tight or somewhere. Generally, probably right in here. So that in the event that it blows through here and changes direction, that you take the stop out and the trade's over. Okay? But we're expecting the market to do this. Come up, hit resistance at some point, and we're not always certain exactly when that's going to happen, and then roll over and start to head either back down into the range or continuing the downtrend down. Now, I do want to point out something else. As you look at this chart, I would agree that if you made the point that it is downtrending because you do have the guidance dot short, You could also make the case what? That you're in a very large range. Yes? I mean, could you not say that there's some resistance up in here and some support more or less down in here? Here again, we have a range. So markets, here's an important takeaway if you're going to think of this in a macro sense. Markets cycle between, most markets at some point, cycle between, yeah, I'll show crude oil in a bit, Jay. Right? Don't worry so much about the instrument, by the way. Everybody's like dollar index. I don't trade the dollar, 6E, whatever, EMD. I don't want to look at that. What we're covering here is just fundamental basic principles that are applicable to any market. It doesn't matter. Crude oil, you could trade Forex, you could trade Apple, you could trade stocks. It doesn't matter. What we're talking about here is fundamental price action. And what I'm trying to illustrate here is that the markets go through periods of consolidation and range-bound price action, like such, and then they go into periods of trending price action, as you see here on the right. Trending price action is where you see price action going like this. Thrust down, retracement up to a lower high or a lower low, and then you see another thrust in the trend direction, like such, and then you see a retracement back up. This is exhibiting trending behavior. And even if you're exhibiting trending behavior, you're still looking to, for the most part, take trades on the probe trade retracements. Because here's the thing, as this market is descending here, like this, see it methodically dropping, you have a red stealth, you've broken down through support here, pulls back up, checks resistance, rolls over, and now you're trending to the downside. It becomes very risky to try to short markets as they descend when they start to thrust in the given direction, because you're going to feel a lot of heat as the market pulls back against you. That's true of crude oil or any chart. Any chart, that's true. So, and I know it's tough to wait for retracements, but let's go back to this trade of getting in at the bottom of the breakout. When you talk about breaking down through support, as it did right here at the bottom of this range over here on the right, can you see this range right here, this range? Here we're talking about shorting resistance on a probe, far superior short entry than a breakdown, because if you short this breakdown here, where does the stop need to go? I'm saying this trade right here. You say, well, I'm going to wait until it comes out of this range and I'm confirmed that the downtrend is continuing. I want confirmation. I want to see this level break to the downside. I want this taken out, and I'm not going to short it until it takes that out. A lot of traders do that. That's what's called a breakout trade, breaking out of a range. Now, the risk in that is that you look at this chart and you say to yourself, well, where on this trade here, this lower trade at the bottom of the range, where do I have to put my stop to protect myself? I might have to put the stop way up here. I might have to put my buy to cover stop at the top of the range, possibly way up in this area right here. So when you think about contrasting the notion of probe or resistance trading versus breakout trading, and we say the term risk and return, the risk on this trade is basically the short from here to this stop right here. That's the risk. And obviously your potential return on the trade is at least down into here, quite possibly further if it breaks it, yes? The risk on this trade, the breakout trade at the bottom of the range, is your stop all the way up here. And where's your potential return on the second breakout trade right here? Where's that return? Well, we don't know, because what we're anticipating and hoping for is that it breaks it and goes to some lower level. I'm going to pause here for a second. Does everybody understand and see what I'm talking about here? The fundamental difference between a probe or retracement to resistance or support, as you have up in here, in a downtrend shorting, and how far superior that is to trying to short a market on a breakout where the stop is so far away. Purely from a risk-return point of view, everybody can see the difference here, right? Anybody not see the difference? of what we're talking about? Shorting the breakdown versus shorting retracement. Almost in every case, you're going to find that the retracement is far outweighs the breakout. There are some cases where that doesn't apply, and we'll look at that in a little bit. Questions at this point? Questions on looking at this range? Yes, that's right, Jim. The risk return on a pullback far outweighs the breakout. Yes. I'd say in most cases, probably fully 75, 80, perhaps as much as 85 or 90% of the cases, retracements. And that's why you hear things like, for instance, when you see a market is trending, since all see this, I'm going to take these trades off and we're going to look forward now, okay? So, for instance, when a market is trending, here we see it breaks down, it comes back up, you felt some heat if you took the breakdown, and then it comes down and it starts to descend. And you can see that these little sort of micro swings that the market starts to put in, when I say micro swings, I mean swings up, swings down, comes up, comes down, pulls back to resistance, rolls over. So for instance, in the live trading room, you might hear something to the effect of, I'm looking for a retracement up into the area of, 81.18 or 81.19, and I'm looking for a rollover to take a short. What that means is, sort of the translation of that, if you will, is that I'm looking for a retracement up into an established resistance area, support resistance area, and I want the market to roll over to give us the trade entry, short, because after all, we are trending now. Does that make sense? The other thing you might hear sometimes when we talk about retracements and or breakout trades is something like, I'm not just going to blindly short 81.17. I'm going to wait for a rollover. What that means is this, is that as a market, let's look at a good example of that. Here, for instance, we can see that we had kind of a resistance area. I think you could make the case right in here. Say 81.03 or 81.04 or 81.05. Now you can see here that it checked it a couple of times, but then it retraced a little bit further up into here. So when we say that, what you're really doing is you're looking for, in this case, what we call in a downtrend a resumption of selling, where you hit a resistance area, you draw your retracement line in, and then we look for a continuation. Questions coming in here. Jim, do you always probe on a trend line? Yes. Yes. For the most part, if you were to try to, in your arsenal of trading, develop a couple of skill sets, I would say some of the most important skill sets, even if you were just going to work on fine-tuning a couple of skill sets to take trades, the first one would be being able to clearly identify when a market is in a trading range. That would be number one. Okay, are we in a range or are we trending? And I think that over time, if you watch enough charts and take enough trades, that your eye will be able to see that. You don't have to do a lot of markings on the chart to be able to see that. That's the first thing. The second skill, which you see in the room all the time, is being able to clearly put in retracement trades or retracement lines into probe trade setup areas, support and resistance, to be able to see the rollover and take the trade entries. Yes, in the direction of the trend. In the direction of the trend. Okay, let's move forward. So we looked at this area, we looked at the trending area, and now let's go forward and see what happens as this market goes forward. Here we have, the market descends, we come into a support area, we retrace, we come up to resistance, another probe trade rolls over, market continues down, it's stair-stepping down. We can see by the red stealth, we can see the market stepping down, going down to a fresh swing low by 84. Here we see what's called a deep probe. Deep probe is where the bars turn the other color. It rolls over and then continues on down. Now let's see if we get another range-bound condition over here. Let's continue on. The market is trending. It's trending down. It's trending down. Down it goes. We like that. We like that. It's continuing on down. It's come out of. Now we come back all the way up into here. Now, you may hear terms like this: line in the sand, mastery trade, things of that nature, right? It's coming up to the line in the sand. It's testing the resistance area. Here we have a case where the market has come all the way back. The bars have turned blue. You can make the case that it's broken out, hence the term breakout, of this lower range, but we're not looking for long trades because our guidance is still short. Right here. Right? Guidance is still short. Now let me ask you this question. As you see this chart in this current condition, and we're starting to set up a little range over here. See the range? Starting to set up a little range over here to the right. When we see a range like this, what should we be looking to do? What types of trades are we taking over here? Right edge of the chart. Follow along with me, everybody. We'll open it up for questions in a little bit. We're trying to get through the basics of breakouts and range and probe trades. We want to make sure that everybody's on the same page. Now I'm going to give you a little hint. If you see this area to the right, which is a little range setting up here, it looks not that dissimilar from over here. Remember this over here? We looked at just a few minutes ago. It's very similar to that. What did we say over here? Isn't that not applicable to here? What types of trades are we looking to take here? And where might we do it? What types of trades are we looking for here? Take into account the direction of the market. What direction is this market going? When we were talking in the past 25 minutes here, what was the types of trades that we felt are superior to breakout trades? And where might we do it? What do we see this condition here? What are we looking to do with this condition on the right hand? Pretend this is 10:23 a.m. Pacific and you're trading DX, the dollar index, and you see a condition like this. What are you looking to do? What type of trades are you looking to take here? I see some things coming in. Short, fading the short. Trend line breaks to the short side. Down, kiss trade. Good. Selling resistance. Good. Absolutely right. Just like this market over here, when it consolidated in this range to the left, the upper left here, we were looking to short resistance areas, weren't we? Remember? We were shorting up in here. And our stop was tight. Just above. Remember, we put the stop up here. Initial stop. We're shorting resistance, and our initial stop is up here in the downtrend. We go into a trending mode. Probe trade, probe trade, probe trade. We're shorting, shorting, shorting. We get a deep probe here all the way up to guidance. All the way up to guidance. Some people call it a kiss trade. Some people call it testing guidance, resistance. There's all manner of names for it. But the bottom line is this, that you are looking once again to short this area up in here. Now, here again, to emphasize the difference between what we call probe or resistance trades, where a market in a downtrend is hitting resistance and you're looking to short up here. Let's put the trade in so you see what I'm talking about. You're selling up in here, you're selling resistance. Now, by the way, you hear the term fade. Does everybody know when somebody says, I'm going to fade 81, I'm going to fade 81 by 3 ticks. What does that mean? I'm shorting this area, but I'm going to fade 81 on the dollar by 3 ticks. What does that mean? I'm fading it. Jim, you typed it in, so you got to know what it is. I'm fading this area. You might hear that from traders. You might hear it in the room, right? Fading. What does that mean? I'm fading 81 on the dollar by 4 ticks. What does that mean? All right. So if you said, let me show you something here so we're all on the same page as far as terminology is concerned. If you said, I'm going to short 81 on the dollar on a retracement, then technically speaking, that would mean that you are going to put a sell order right at 81. Yes? Isn't that what that means? I'm shorting 81 on the dollar. Now, we can see that in some cases, as this retraces up to resistance in this downtrend, that the market may or may not hit 81. Most of the time, a candle has to trade through an area and close above or below it to get filled, yes? So if you put a sell order right on 81 on a button or even slightly higher, you may or may not get filled. Now, if you really want to get filled short, when we say the term fade, we're talking about, in the case of a short, coming slightly below where the entrance area is. Now, you have two choices here. You have many choices, obviously, but I'm going to illustrate a couple of choices. As this market is retracing back up into resistance, as it did right here, if you feel that this is a good, strong resistance area, and it looks like it is based on these swings, right? Looks like a pretty good resistance area. You can go ahead and put this sell order in ahead of time, fading the area by a few ticks, okay? And your initial stop is going to be up here. You're selling, so you put a protective buy stop up in here in case it breaks out against you, right? Now, if you don't want to just put an order in there because you're concerned about the fact that it might go a little beyond here and you don't want to feel any heat and get stopped out, then the other way to do it is to draw your retracement line as you see in the room, right, on the live markets, and then you simply wait till you can either hit a market order or you can sell it as it comes back down through the retracement line. And many of you have seen dozens and scores of that type of trade, right? We draw the retracement line up into resistance. We want to see it roll. So maybe you get filled short, you know, somewhere in here, possibly. Does everybody see the three different approaches to a retracement trade up into resistance? By the way, this order here as it rolled could be a market order too. It doesn't have to be a limit. You can put an order up in here right at the resistance level, and whether or not you get filled on the wick of a candle, it might miss you and roll over and you miss a nice trade. That's the risk, yes? If you fade it, you can put a sell limit order in a couple of 3-4 ticks sort of ahead or below where you're wanting to get short, ensuring the fact that as it bounces up here, you're probably going to get filled. Or you can hit a market order or put a limit order in when the market retraces. Now, when you look at this range that starts to be being put in here, you can see that we challenge support, we come back up, and now we have established a support area down in here. Now, if you did not short the market up in here and you put a sell order down in here, when it takes this level out, what type of trade is that? Okay, you didn't short the probe. All right, you're not short up here. You didn't do this. Maybe you're just not a probe trader. You just, for some reason, you don't like probe trading. You say, well, I need to be convinced that this range is going to be broken to the downside. What type of trade? If you put your order here instead of up here, what type of trade is that? What do we call that? Good. Right, Ken, Phil, Billy Ray, everybody? That's your breakout trade. That's your breakout trade. You are looking for a breakout of a range. Now, the reason you put a sell order in here is because our guidance is short and we're in a downtrend. In other words, inside of this range that's forming here, we are not, until proven otherwise, looking for the market to break this way, to the upside. We are expecting, our expectation is a continuation to the downside, and that's why we're looking for a short. Here again, in this range, if you short the breakout to the downside, the tough part of this is that now you have to put your buy to cover stop way up in here somewhere, right? Oops, these two are connected. Oopsie. You know, buy to cover stop way up in here. So here again, the risk on the probe trade is between the sell order and the stop, which is like such. That's the risk. The potential return is down here. Shorting the bottom on a breakout and putting a stop at the top of the range is now establishing a risk of this. And your return is a possible hopeful break of a breakdown. Here again, I'm trying to illustrate that probe trading, selling and buying retracements in a trending market at or near resistance, fading buying, fading selling, is far superior to breakout trading, and that's why we do it. All right, any questions on the dollar? I've got 1, 2, 3, 4. I got a whole bunch more charts. We've already chewed through almost half the time. So any questions on the dollar here, what we showed? Because I'm going to start moving into some other charts. Questions on the dollar trades. I'm going to take this off. I'm going to replace this chart with another one. Stand by. Any questions on the difference there between a probe, taking a retracement type trade versus a breakout? I don't see any. Okay, good. Moving on. We had a question on oil, so let's get oil down here. So make Jay happy. Stand by. Drag an oil chart over here. Loading up the oil chart. Stand by. One more minute, please. All right, here's crude oil. And I believe this was from today. I am 99.99% sure it's today. And it's this morning. Okay? All right, so here's crude oil. There you go, Jay. We'll get your crude oil loaded up for you there, buddy. All right. Now, since we have so much to cover, I can't, get into a lot of detail about putting support and resistance on charts. I'm assuming that we all know how to do that. All right, so I'm just going to put it in so we can move on with the trade at hand. Here we see we have support more or less down in here. Oops. I'm referring to this range right in here. I'm referring to this range right in here. This range right in here. All right. And we see that we have resistance more or less up in this area right in here. This tool's not working for me. 96.18. So let me ask you a question. We clearly see that we are in a range. No question about it. Bill D there, good times to trade oil are around high energy times. Shortly after the inventory number on most weeks at 7:30 a.m. Pacific time on Wednesdays. Thursdays, today's good. You normally get nice rolling days after inventory. And shortly after the crude pit open, which is 6 a.m. Pacific time. Follow along here, though. This is important. This is really important that we focus on this. Just hold your questions for a minute, please, because what I'm going to show you is incredibly important, and hopefully you can take this away, and it's going to save you a lot of headache and money. All right? Should I put an order to buy a breakout, this would be a breakout trade, 2 ticks above this level right here, yes or no? Here we see crude oil is consolidating. We see that the trend is up by way of our guidance dots down here. We see the market is heading higher, methodically, sort of drifting higher, although it has consolidated in this range right here. Should we buy this breakout 2 ticks above the swing in 18, yes or no? It's a very simple question, yes or no. Buy the breakout, yes or no? Think about it. Look at the chart. I'll give you a minute. Should we buy that breakout, yes or no? If you see this trade tomorrow morning, if you see a chart, let's say you're trading, the E-mini S&P, whatever, and you see a setup, it looks just like this, and the data's coming in, and it's shooting all over the place, and it's bouncing around, and should you buy that, yes or no? It's going to break out, yes? Oh, good. There's only one person that said yes. All right, let me read some of it. There's one yes, and overwhelming, all the people, almost everybody in here tonight said no. And a couple of you, hey, Lee, long time no see, how you been? Here's what Lee says, no, I would let the breakout occur and then wait for a retracement and buy it on a confirmation on a resumption of buying. Good for you. Wait for a pullback, says Chris. Guidance is long, wait for a pull risk, says Jim. Good. That was a trick question. That was a trick question. Now let's see what can happen in buying breakouts and the risk inherent to breakout trading. Let's see what happens. Ready? All right, here goes crude oil. Pulls back into this higher support level. That's good. That's good. That's good. Boom, boom, boom. You get 3 candles. We get filled. Pulls back a little bit. Excuse me. Pardon me. I would say that you got filled probably in one of these candles right in here. If you put it 2 ticks above 18, You felt a little bit of heat, you know, a couple of 4 or 5 ticks on that pullback there, and now it's starting to move in your favor. Uh-oh. What's going on there? What's that? Now, by this point, you're down about 13, 14 ticks. You're down about $130. How many of you would panic and dump the trade right about there? Anybody? 14 ticks. You're down 140 bucks. Holy smackabony, I'm getting beat up here. What the heck? I bought the breakout. Panic. Hit the panic button. Get me out. Out. No mas. No more pain. This 140, I can't take that hit. I got to get out. Let's see what happens. Uh-oh. What happened there? You were left down here in this circle. What did it do? Now, how many times has that happened to you? You buy in somewhere, you feel some heat, you dump it, and then it takes off, and you could have made 20 ticks. How many times has that happened? It's like the market knows where your orders are. What the heck? What kind of market is this? Every time I get in, they pull back against me, and I get out, and then the stupid thing runs. What kind of market is this? Every single stinking time. How do you avoid that? How do we avoid getting sucked into trades like this? Well, first of all, let's go back and look at where we were, okay? And I'm sort of joking around with everybody, but let's get serious about it, okay? Here's the deal. Here's how this works. First of all, we see that in actuality, we should have been buying down in here. And if we learned anything from what we talked about in the past 45 minutes, is that we should, in an uptrend, as we are here, just like a downtrend in the opposite direction, of course, that we are looking for probe trade retracements into support to buy. These are the highest likelihood return of type of trades in an uptrend because we are essentially buying support. You can fade it. Here we see support is down here around, 85, 86, 89, 87, right in here. We're fading it by a few ticks, and we get filled up here. Okay, we're getting filled. We're fading it by a few ticks, so we're buying, and we have a very tight stop that's over here. Our sell stop is down below support, and so our risk on that trade is this, on a stop out, yes? And our potential return, you can just eyeball it, right? Yeah, that was Lee. Lots of very good probes. That's what I was trying. That's why I'm circling back to point this out. See the probes, see the probes, see the probes. And your potential return would be a minimum of up to here, yes? I can't say that's 2 to 1, but it's at least maybe 1.5 to 1 risk-return ratio. And when the market pops up, you take a little profit. And if you have 2 on, that's the ideal, is to trade 2. If your risk profile can afford for you to take 2 trades on this instrument, $10 crude oil, we're trading a July contract. And most of you know how to get in, of course, right? We find this resistance area, it pulls back, 45-degree angle retracement line, or we fade it on a limit order. And then, you sell and you take some profits at the swing here because we're trading a range. You take 1 off, and then you have a runner on the second one. We all know that, right? I'm not going to go through all that. We have many, many entire webinars talking about that strategy and approach, right? Can you see that this entry down here at the probe of support is far superior to this entry on a breakout up here? Because once again, just like the short trades, where will we have to put the stop on this? On this trade right here, this breakout, where would your initial stop have to go? I would say at least probably down under here, because you have swings down in here, yes? So now your risk on that trade, on the breakout, is all the way down here. And where's your potential return? Now when you got filled on that little block right there, that little shotgun of bars around 1054 Pacific, and it pulled back and started to give you some heat, you might have pulled your stop up into here. That's what I was trying to say. Maybe you got nervous and you pulled your stop in, and it takes you out. Now, how do you avoid that? Now, here again, I'm going to circle back. I'm going to say, okay, well, Charles, here again, I'm just not a probe trade person. I can't, for some reason, it's like catching a falling knife to me. You know, I don't see this well. I can't buy this area. I'm not good at fading it, whatever. That is perfectly okay. Now, here's what you can do. Let me tell you what you don't want to do. You obviously, it's your trading account. You can do whatever you want with it. But our strong suggestion is this. And you heard some, Lee and a few other traders type this in. Okay, we're not going to blindly buy a breakout trade like this because of the head fake potential and the risk of getting stopped out on a pop through resistance like this. All right. The critical part of this is not the breakout in and of itself. That's what I'm trying to say. The significance of it breaking out is not the important part of the trade. Let me ask for you veterans in here, what is the important part of a breakout like this? If you're going to trade breakouts, this is the one thing you're going to want to remember. It's not the breakout itself, which is interesting because most people think that it is. Most people think the significance of this trade coming out of a range on a breakout is the breakout in and of itself, these bars right here. That's not the important part. What is the important part of a breakout trade? Anybody? No, it's not the bar color, Jay. What else might it be? Let's look at the chart here for a second. What's the significance of the breakout trade? It's not the breakout itself. What are we looking for? Let me help the team out here. What are we looking for after the breakout occurs? Sedley. Hey, Sedley, how you doing? The retracement. Yes. Everybody in here tonight, if there is one thing on a breakout trade that you leave with that hopefully will become ingrained into your trading psyche, it is this. Most times, I can't say 90% or 100%, but I can tell you a vast majority of times, you don't want to take the breakout itself because of the risk of head fakes and getting stopped out. The key to taking the breakout trade is to patiently, and this is where the patience comes in, and this is the hardest part of trading, right? Wait for the retracement to occur. In the case of a long trade, it would be a higher low, like such. Look for it to come into some support area. Draw your retracement line just like a normal probe trade, right? And then look for the market, in this case, to break to the upside, which your buy would be in here, either by limit or by market, as it comes back up through, right here. See it coming back up through the retracement line? It finds the higher support level. It comes back up. It takes out the resistance level and starts to precipitously move higher. Now, the advantage of doing this, and let me blow up and tell you the difference, multiple differences. First of all, your initial stop on this trade is now going to be located here, just under the swing. See the stop dots? See the swing and the stop dots right in here? See how you waited for the resumption of selling? I mean, you're an uptrend. Resumption of buying. So you're buying in here, you're getting filled, and your stop is here. So now your risk is no longer from here to here. Now your risk is from here to here, initial risk. And then, of course, we all know that as the market starts to move precipitously in your favor, you take your trailing stop up. This is your initial stop right here. Initial stop, right? And then the market starts to move up. This little piece of price action is probably, on a breakout trade, is probably one of the toughest and most challenging type trades to master, simply because you have to exercise a lot of discipline and patience as the market is flirting with this breakout, because sometimes it breaks. And the reason for that is because we can never accurately always predict how and where it's going to retrace to. You see, some markets will pull out and they'll pull back very shallow and then they'll take off. Some will pull up, sit on there for a while, and then take off. Some will break out and never look back. And here's the thing. If you're going to take those types of trades, then you have to master the skill sets to do it and look for price patterns that you're comfortable with, and then take only those. And if something deviates from that pattern that you're comfortable with and take repeatedly, then step away from it because that's going to represent losses for you. But I think everybody can see clearly that the far superior entry if you're going to trade is the probe trades at support in the trend in the direction of the trend. Does everybody see this? This is more or less the crux of what at least a big chunk of what I wanted to show here tonight, which is how to deal with a breakout, potential head fake, the risks associated with breakout trading, and how buying support, probe, pullback, retracements, and from a risk return and just a trading perspective are much better. Questions on crude oil? Because I'm starting to run out of time, and I got a couple more other charts to show here. A couple more charts to show. You want to see another breakout? How do you get the dotted line? These dots are the breakout, the Viper indicators, and it's the trailing stops. So the dashed lines here are what we call the swing high-low. So it's showing you where the swing high-low is. It's particularly helpful when you're in a range because they stay in a particular area for a longer period of time. It makes it a lot easier to see support and resistance on the swing high-low dashes. And then the dots are, of course, the trailing stops. In this case here, of course, when you bought in here, here's your trailing stops coming up, trailing stops coming up, trailing stops on the trade. And then it keeps going. And, you probably, on this long trade here, you probably got stopped out, probably somewhere up in here. Nope, I got filled. Let's make sure I'm in sim. Hold on. Yeah, sim. Okay, that's good. And we don't want to be trading now. Spreads, how much liquidity we have here. A couple of ticks spread. See, that's the risk of trading after hours, by the way. Most of you know this, is that sometimes you got to look at the liquidity. How much bid and ask. Sometimes if it's 1-1, 1-2, 2-1, you're not going to be able to get in and out with multiple contracts very easily. And if the spread is large, if you got a spread that's like 3, 4, 5 ticks, you got a $10 instrument, it's going to cost you $20 plus commission to get in. Right? So we don't want that. So we're going to close this out. Close that sim position out of there. Question from Ahmed here. How do you know that a breakout will go up or down? Is there any golden rule for this indicator? Well, what we were saying earlier, Ahmed, is that when assessing, looking for breakout trades or probe trades in the direction of the trend, one of the primary motivating factors, aside from just sort of eyeballing it and seeing that it's stair-stepping up and trending upwards, is the guidance dots. So you see these dots down here. See how they're stair-stepping up and the market is remaining above it and putting in higher highs and higher lows. So in an uptrend, you really have a couple of choices. In an uptrend, the choices are you try to buy breakout trades, like we showed here, or the superior entry is buying retracements into support. I mean, there's other options in here. There's other things you can do. But if you want to just keep it straightforward and simple and look at sort of the basic type of entries, in an uptrend, you're looking to buy support, retracements into support. Jay asking about auto trading software. We're not really set up to do that in this. This is a discretionary webinar. If you have more trading questions on the auto traders, we should probably touch base tomorrow on that, either towards the end of the trading room or perhaps in a Skype chat. I'm going to run out of time here in about 4 or 5 minutes, and I have a couple other charts. Unfortunately, these are. But one thing you can do, Jay, on the auto trading software is, are you a member? If you are, go into the. If anyone who is a member, go into the subscriber area. This would be a good place to start on the auto traders. Right in here. If you're interested in auto trading or want to learn more about auto trading, we have several. I've actually done myself personally several webinars associated with the auto traders. So you're going to scroll down into this area right here, webinar recordings, about a third of the way down, and then on the left here, you're just going to look for. I think I had Viper Auto Trading 1 and 2. Let me see if I can find it real quick here. This would be a good start for anybody that's a member, subscriber that wants to learn about the autos, how to optimize, how to use them, what the setups are. Stand by. Where the heck is it? Where the heck is it? Here's one here, new autos and indicators. This would have been back in March. And then there's a couple other ones you're going to have to dig down here a little bit lower. Trading made easier. Viper Basics is a good place to start for your basics 1, 2, and 3. And then over here there's a couple of ones that were dedicated just strictly to the auto traders. It goes through optimization, what all the settings are, how they work. Yeah, for the autos. Okay? Derek, just took your recommendations on Breakout Trade 6J. Got 36 ticks on a trade on a pullback. Good for you, Derek. Nice trade. Yeah, they work. I mean, you know, here again, from a risk-return perspective, when you're in an uptrend, you're generally wanting to buy the pro pullbacks as opposed to, you know, you put your sell stop under the swing. You know, you've got limited risk here and much more upside on a potential return than getting sucked into a potential head fake, risking getting stopped out on a pullback, feeling all that heat, which is unnecessary, versus waiting for the market to do its retracement and then break out. What's the moving average used on the chart? Bill, there aren't any moving averages on here. We don't use any moving averages in our trading. This is all Viper Pro indicators. The Pro indicators they come out as part of the package is the bar colors, blue, yellow, and red. The swing high, low, and the stop dots. The guidance dots here, these big chunky dots that are showing the uptrend, and then the platinum package. We have, I think, the right edge on here, which shows sort of the band area, which represents a buying area. That's part of the platinum package. Some folks have to take off. Okay, Jay. We'll see you in the room tomorrow. Some folks taking off. I'm going to wrap here in a couple of minutes. Can you show the best entries on this oil chart? We did, Bill. Did you come in late? Yeah, it's retracements. Retracements. You want to see retracements. Let me show you a couple other ones here real quick. You know what? Tell you what. Let me see if I can. Tell you what. We spent a lot of time on this one. Before we wrap here, I only have a few minutes left. Let me try to bring another chart over here and show you another quick sort of retracement breakout type scenario here. Okay. All right, I'm going to drag. Stand by. I have like 3 more, but I'm running out of time. I'm going to show at least one more. Stand by. So these lines here may look like some type of moving average, but trust me when I tell you they're not. These are not. There's many calculations that go onto this. It's not anything related to. If you don't believe me, do me a favor. Put the indicators up here. Put an EMA up there of any size of your choice. You'll see the difference. Alrighty? Stand by. Anybody trade the E-mini S? No problem, Satan. You can ask. Absolutely. There's a lot of folks wondering about that too. So let's get anybody trade the E-mini S&P? E-mini S&P traders? ES? I know some of you like it. Some of you don't like it. Couple people trade it. Okay. E-mini S&P, E-mini S&P traders. All right, I'm going to show an ES chart here. Stand by. I'm going to show it 1 second. A couple of them, a couple of you. It can be a wild beast. Sometimes it's fast, sometimes it's not. Okay, I'm going to show an ES chart, but this could be any equity chart. If you like the Russell If you like EMD, if you trade NASDAQ, by the way, NASDAQ at $5 a tick and YM are good instruments to start and sort of train and learn on if you're just getting into futures. All right, last chart, last couple of questions here. If you saw a market that looked like this, what would you do? The market looks just like this. Tomorrow morning or tonight or whenever you trade, you pull up a chart of your favorite instrument. Could be anything. Could be 6A, the Aussie dollar futures, B, 6B, British pound futures, anything. And the chart looks like this. What would you look to do? Billy D, that's a pretty broad question. What are the best instruments to trade in the current market? Tell you what, Billy D, are you going to be in the room tomorrow morning? You going to be around in the morning in the live room by any chance? That's a pretty broad question. Yeah, because there's going to be more time that we're kind of running out of time tonight, and I did have a couple other things related to trading to show. You know, obviously the equities, ES, E-mini S&P, the YM, TF, equities at higher energy times in the mornings, currency futures, 6B, 6E, dollar index in the Euro session overnight, starting at around midnight Pacific time. Crude oil, high energy times around the pit open, 6 a.m. or inventory days after inventory. Those are all good instruments to trade. What will we be doing? Back to here. Are we buying? Are we selling? Where are we getting in? What are we doing? What is going on with this chart? What is happening here? Should we have bought this breakout? Are we too late? What happened here? It broke out. What was that? What's going on? We missed it. Here was the trade, right? Look, it broke out. We missed it. There's no trade here. I don't see a trade. What the heck? What's going on? Comes up, hits these strange, weird-looking big dots, pulls back. What is that? Buy. It's a probe entry. That's right, Lee. Most of you correctly named this. Chris, good, everybody. You draw a retracement line. This is a trend change. This is the first probe pullback after a trend change. Prior to this area, the guidance dots had been short. We had been looking for short trades. The market comes in and it breaks through, and the trend dots change to down. I mean, from down to up. Down here. After it had broken through this trading range, which is the breakout, which we said we don't, generally speaking, want to take the breakout, which is this. It broke out, yes? However, the breakout, as we said 10 minutes ago, is not the most significant part of this trade. It is where it retraces to. In this case, you can see that it is pulling back nicely into a potential support area, which is located in this band right here. See it? We are looking for a bounce from a higher level of support to buy. We're looking for a long entry. Well, Satan, you don't know if it's going to break out. That's what we're trying to show. In real time, you don't know. You don't know which direction it's going to go. And what I'm trying to illustrate to you, the fact that it broke out is not the important part of it. Right? Let's do another scenario. Let's suppose it came down here and checked support, checked support, checked support, and then broke down like that, took that support level out. Should we sell that? Are we selling this? If it went the other direction, will we sell that? Breakdown. Is that what we're doing? Right here on the top of this resistance area. Are we buying here? Should we be buying right here at this breakout area? Are we buying? Right, 2 ticks above this resistance. Are we buying here? Yes or no? Are we buying that breakout right there? No. That's what we spent the past hour talking about. This is an important takeaway for everybody, right? It's not the breakout in and of itself. Please remember that as you trade. You aspiring pro breakout trading traders. We generally speaking, in most cases, want to wait for some kind of retracement. In this case, if it broke down, we would wait patiently to see where the market retraced to. Look for a logical rollover to short the market. Likewise, on a break up, we wait patiently for the market to break in that direction, and we wait for a retracement. We look for where it is going to bounce, which it does right in here, and then we look to buy on a limit order or market order right in there. Your initial stop on the long, of course, is right in here. That never happened. So it's not, that was hypothetical down here. That never happened. Does everybody see that? I'm getting ready to wrap here in a few minutes. This is really important. I'll just make it real simple if I can. General rule of thumb, do not buy the breakout in and of itself, because there is inherent risk of getting stopped out on a retracement back into head fake type scenarios. We need to have the discipline, if you're going to trade breakouts, to wait for the retracement, draw a retracement line, wait for a resumption of selling, buy the market as it continues to break up in our favor, put the initial stop in place. After it moves in your favor a couple of 3 to 4 ticks, get the stop up to break even, and then trail your stop up from there. All right, everybody, I'm going to stop the recorder. Thanks for coming.